So sure, in the short term, there's enthusiasm. My own view is that the economy is slowing down. Fed policy acts with a lag. That means they continue to push things down. And unless they are in earnest, ready to ease and ease aggressively, we are going to have a hard landing.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart. We got something special for you here today. I am in discussion here with Fed watcher Axel Merk, who very kindly, on very short notice, agreed to come on the program here. I am going to be asking him some general questions about his reaction to what the Fed released today, and then also what Fed Chair Jerome Powell had to say in his press conference. And of course, the markets have responded wildly to that. So we're going to get into that in just a moment. But this is a live event. And so after I sort of help Axel set the stage, I'm then going to be pulling questions from the live audience here, folks. So folks, as you have questions, please use the live chat to ask them. I will be using that to pull questions from. And just a reminder for folks that are watching, if you're watching this live, then you're one of the premium subscribers on my Substack. This is one of the special perks you get as a premium subscriber. It's the first time we've tried this. If it works well, we'll do this more in the future. If you're watching this the following day or after that on the main YouTube channel, if you're watching the replay, you get to watch the whole thing as well. But if you're interested in learning how to become a premium subscriber and participate in these live events, I'll give you the details at the very end of the discussion here. But first and foremost, we are fortunate to be joined here by Axel Merk, founder of Merk Investments and Merk Funds, the family of Merk Funds. Axel is no stranger to the Fed. It's an organization that he has studied closely throughout his career, and he's got some professional ties to them. Axel, I believe you may still perhaps have a board member of your company who was a former regional Fed president?
Senior economic advisor. We work with Bill Poole. Great to be with you, by the way, with Bill Poole. He retired in the spring of 2008, a brilliant mind, harsh critic of the Fed, a super harsh critic of Fannie and Freddie and everything that happened pre-2008. He spoke up before the financial crisis. But before we go much further, you introduced me as a quote-unquote Fed watcher. I just want to make it clear that I'm not an economist at heart. Many people call me an economist. The reason I watch the Fed is because I'm an investor. I'm a human being, and they have a bazooka that's very powerful, influences the markets, and therefore I believe I have an obligation to pay attention to what's happening. I'm a type of person who always likes to go to the sources, and so that's part of the reason why we work with a former Fed official, gotten to know several Fed officials over the years, to make up my own mind. Doesn't mean we're right or wrong, but I do think that it's when somebody has a bazooka, you might as well know what they're up to.
That's a good way to put it. If someone on your block has the biggest weapon, you want to be paying attention to what they're doing. All right, look, well, for those that were not watching, we're not as glued to the screen as Axel and I were today. The Federal Reserve came out. They, basically largely as expected. In other words, they didn't. They stayed flat, right? They stayed put. They didn't cut. They didn't hike. They did put out a very mildly edited statement compared to their last one, which I'll actually put up on the screen here in just a second. In fact, I'll try to do that now here as we're talking. And actually, if you want to talk to any of these changes, you're welcome to. I'll pull that back up in a second. But I think what was the market reacted to was in terms of their forward guidance, the FOMC basically increased their expectations or their guidance for rate cuts next year from 2 cuts to 3 cuts. In Powell's subsequent press conference, he emphasized the good progress and the Fed's level of happiness with the way in which things were unfolding here, that things were very orderly, that things were heading in the right direction. To a certain extent, I think he said, it looks like we're winning the war. Too early to declare victory, but things are looking good. So he was kind of up and positive. So all in all, Axel, this is what I took away from, and then I'll let you respond to this and let you just run in whatever direction you want. But he seemed to be kind of pretty pleased with everything, and it came across as pretty dovish. This was definitely not a Jackson Hole where he, tore up his speech right beforehand and said, I've got to come in and quash the animal spirits. The markets are just, they're just too euphoric right now. I think a lot of people, myself included, were expecting him maybe to come in with a little bit of a sledgehammer and tell the markets that, hey, everybody's kind of getting ahead of me here. But he definitely didn't seem to do that this time from my perspective. What was your take?
Well, he did tear up the script, I think, in a very different way, though. Remember, have you heard about the higher for longer sort of framework that he has been pounding the table on? He did mention those words, but only in referencing some history, I think. Mike McKee from Bloomberg asked him that the market priced in all this tightening before you actually tighten. So now they're pricing in all these rate cuts and so forth. So what's going to happen going forward? And he didn't quite know how to answer that question. And all he then kind of said that, oh, the economy is in better balance now. And then he started to get going on this, the economy is in balance, presumably suggesting that mission accomplished, right? It doesn't have to be hawkish anymore. And he was also asked about, well, how do you make sure that you're not overdoing it? Because one of the things I've been saying is that Fed policy acts with a lag. And so, of course, by the time that you stop doing anything, there's going to be a ripple effect down the road. And he says they're going to be very focused on that. Well, what's missing and continues to miss is a strategy. You mentioned forward guidance. Forward guidance has been declared dead. Well, of course it's not dead. Of course there's forward guidance. Higher for longer appears to be out. So what's in? So the economy is in balance. Is that what's in? And the reason why any on all of that matters is, again, A, they have a bazooka, and B, they set the risk-free rate. They set the reference for risk assets. And when it's not clear what they will do, and notably also when it's not clear what they want to do, that creates volatility in the markets. Before we went live, right? Somebody tweeted, "Oh, this is going to be bearish call." Well, it's not about being bullish or bearish. It's about there is somebody who sets the risk-free rate, and so we got to know what to do with that. And if nobody knows what's going to happen with that, that creates issues in the markets. And it doesn't mean markets will go down, but I do think it will. It does mean there's going to be more volatility in there, and it means less efficient capital allocation, less economic growth that there would be otherwise. And so it creates all kinds of unintended consequences.
So when you say less effective capital allocation, so basically the markets just went bananas after, well, certainly
not so much technical language. Bananas is CFA level 4, so you got to.
Yeah. Well, they became very. I don't know if euphoric is too strong of a word. I mean, they pretty much everything went up. Some things up big after the announcement, and then certainly as Powell was talking. And so I want to get your reaction to that in a second. But when you talk about ineffective or inefficient capital allocation, are you saying that with a concern of we maybe heading back to the old script of Fed just making the markets too confident, eventually making capital so cheap that we just get a bunch of malinvestment, like was pretty much the script for the past 20 years?
No, what I have a problem with is the reading of the tea leaves that we're all forced to do. Just imagine this abstract world where we would focus where inflation will be, and notably also unemployment will be, and rates would be set on that. Then we wouldn't have a discussion about the latest utterances of Powell, but we would have a discussion about inflation. We're not having that discussion. And the reason we don't have that discussion, because the Fed is again in the game of micromanaging where they want rates to be. And that's, of course, they got the bazooka. That's what we got to deal with. I guess it keeps you in business because you can ask people how to read the tea leaves, but it's not helpful for investors. And so now, obviously, we can complain all we want. And you mentioned the market reaction, right? Reading the tea leaves, it is mission accomplished. It is a new era. The new era is that this economy is now somehow balanced. If he's not going to backpedal on that, which he very well might, because I think that wasn't pre-planned, that he talked about that. And that means, yes, they can cut rates more in earnest, they can cut them earlier. Obviously, if you look at the famous dot plot, which by the way used to be pushed aside as something, oh my God, we shouldn't rely on that, whereas now it's become a communications tool, that the Fed is going to lower rates, and so they're cool with lowering rates. And just why would the Fed do this? I believe part of a good reason why is because we have started to see the classic indicators as to an economic slowdown. And you pulled up the FOMC statement comparison, and it says very clearly in the very beginning, right, growth has slowed. And some economic data are good, but there are clear signs that this economy is slowing down. In addition to that, inflation is lower. Well, if you package the two together, which means Fed policy can be easier. And I put that arrow in there on the any part. It's because Powell emphasized it, and it is there. And of course, why do you add a three-letter word? And Powell just said, well, they want to keep optionality open just in case things don't work out the way they want to. But yes, we're done. I mean, he didn't use exactly those words, but that's the message here. And yes, that's a new environment, and that's why bonds move, and bonds do set the pace. And then equities, gold, everything else reacted accordingly.
Great. And sorry, I found a way to display what bananas looks like. This is what the market was like today. So this gives you a sense that pretty much almost anything that could go up did go up. We'll get to gold in just a little bit, and I see some questions here about gold, Axel. So, we'll put a pin in that one. But high-level question, and I'm just trying to get some of these high-level questions out of the way so we can get to people's specific ones in just a moment. It's a hard question for you to answer, but I'm just going to ask it anyways. Is this a victory for the bulls? Is this a victory for those who said, you know what, the Fed's got this under control, and we don't really need to worry. The bears are much too concerned. We should be going along. Next year looks like it's going to be great. Powell just gave us the green light to go ahead, and all is good, and we're back to everything is awesome? Or is this, from your experience, one of those times where, if you look at history, right, markets tend to rally right up into a recession. Most recessions that we've had recently have happened after a Fed rate hike regime, and that's plateaued for a while. We're right there in the script. Is this more of are these more conditions to worry about going forward, or to be happy about going forward?
So first of all, any investor that ever says everything is awesome should really take some chips off the table, because investing ought to be frustrating. And when everything goes the way that you think it does, it's about to turn. So just in general, no matter whether you're bull or bear or anything. But to address, I think what your question is, well, why is the Fed doing what they're doing? It's because they see the economy slow down. Now, if history is any guide, if you have a soft landing, then risk assets, equities, look through that and they can do very well. If you have a hard landing, then risk assets tend to perform rather poorly, because the downward earnings momentum is reflected then in the stock price more readily. So if the Fed pivots from higher to longer to the economy is balanced, inflation is lower, economic growth is lower, that means they're ready to cut. That means maybe they're seeing something we don't see. So sure, in the short term, there's enthusiasm. My own view is that the economy is slowing down. Fed policy acts with a lag. That means they continue to push things down. And unless they are in earnest, ready to ease and ease aggressively, we are going to have a hard landing. I still don't think that they have the ability to ease aggressively. I think the 70s continue to haunt them. But that little victory lap that we saw, and I call it such, maybe that's what's going to be it, right? How assets are going to react? Well, sure. If they were to cut rates sharply, promptly, yeah, risk assets can do well. Historically speaking, in a soft landing, as I point out, right, equities might do well. In a hard landing, precious metals tend to do better because they have the more imminent reaction to the Fed easing. Also, funding is more readily than provided to the mining companies, whereas financial conditions continue to be tight. And then just one word on the jobs report maybe that we had last week. Historically, and I think you alluded to that, historically, the job market is fine until it's not. It tends to fall off a cliff. And so it's anyone's guess, right? And the good news is that people disagree. And that's what makes a market, right? If there's something I like about these markets, is that there's a disagreement.
Yeah, so Yeah, I mean, that's what makes a market, and for sure, the bulls just got a healthy dose of what they need to push things up from here. So the bears, have got their work cut out for them if they feel differently. So, Powell talked a lot about how things were coming into balance, right? Economic growth was slowing, and that was a good thing because he was comparing it to Q3 economic growth, which, in his word, that would be running too hot to get inflation down, right? So for him, he's painting a slowdown in economic growth as good, continued disinflation as good, and he talked about the labor market. What did he call it? Equalizing or something like that, but basically becoming less tight, right? Now, all those things, if you took them to their extreme, aren't good, right? Too much slowdown in economic growth is recession, right? Too little inflation is deflation. Too loose of a job market means that people are losing their jobs and can't find jobs, right? So, people are hoping that the Fed is going to engineer a soft landing. One could use the term thread and needle. We know that the Fed has actually pretty crude tools for what it's using here, and its track record of surgical precision is very low. And I'm not trying to kind of, step into that guy's prediction that, oh, this is going to be a bearish discussion. But you're clearly worried, it sounds like, that the lag effect still has yet to catch up with us. And if it does, it could really wreak some havoc going forward. I'm curious, if you were in Powell's shoes right now, would you be cutting already, given that concern?
So first, let me address an issue you raised just before, and then I'll address the question. Sure. There are different philosophies about how the Fed acts. The folks at the Fed tend to think, not everybody, that they can micromanage this thing. I had a discussion, it's over a decade ago, with Don Cohen, former vice chair at the Fed, and he would talk about kind of being able to calibrate things a little bit. If they overshoot and this is all not a big deal, they'll just adjust, they'll just take care of it accordingly. If, quote unquote, I were in Powell's shoes, I've always argued that the best short-term policy is a good long-term policy. And that's why I started out this discussion we had with lamenting that the Fed doesn't have a strategy, right?
It is far more important.
You need to have a framework. You need to have and the best framework. And to take a step further back, right? The Fed gave us the Great Depression. They gave us great inflation in the 70s. They gave us this bout of great inflation. It is just not acceptable to double down. It's like just as bad as when university trustees suggest that, oh, we now include Jews as a class that needs to be protected, rather throwing out the entire DI concept. So similarly, what needs to happen, sorry for getting off a tangent here, but it's the same sort of thing. The Fed needs to throw out this decision making by committee. That is by definition always late. And they have shown over and over again that it has bad implications. There are better ways of doing that. And the better way is to have a rules-based approach. So if you ask me, what should be done is you should have a thorough review of what's been going wrong and throw out the old and put in something else instead. Instead, we still have this backward-looking idiotic, that's a CFA level form term as well, framework in place that's backward-looking inflation. That is still the official mantra at the Fed. Powell has refused to acknowledge that serious mistakes have taken place, pointing to an upcoming 5-year review. And the only thing is that said, oh, everybody else got it wrong too. That is not what people deserve. We deserve much better. And so if you ask me what needs to be done is, yeah, you need to say, all right, we screwed up. Let's get back to the drawing board. And if it means that we all lose our jobs, then that's fine. Because there must be a better way of doing this. And yes, there are better ways of doing this. Now, clearly there are other drivers, and we can't just say, hey, some people say, hey, let's stop printing money altogether. Well, if you're hostage of huge deficits, somebody needs to pay for that stuff. And so central bank independence only goes so far. But there are much, much better approaches that can avoid the sort of things that have happened, notably the great inflation we've had.
Okay. And somebody asked Powell that sort of like, look, you guys were kind of late to start the tightening campaign, right? And And basically sort of how can we trust you, not to be too late in cutting, right? And Powell kind of gave this sort of evasive answer of like, hey, you know what? We are just laser focused on price stability and achieving our dual mandate. And we think about this all the time. And yes, we can't wait until inflation gets to 2%. We have to start cutting at some point before then. When is a little tricky. We're doing our best to figure it out. But he kind of just sort of gave us this sort of like, just trust us, trust me, answer, which of course, really hard to do with these guys because they're track.
Let me just talk about the trust me, because we can complain about the Fed all we want. You can measure the trust in the Fed, and the way you measure the trust in the Fed is looking at longer term indicators, right? Nobody has a clue what inflation will be in 10 years from now. But if you look at metrics about what the market prices in for 10-year inflation, the TIPS yield in this case, or looking at metrics like that, they are a reflection of the market's confidence in the Fed's ability to contain inflation, right? It's one of the reasons why people are saying, well, all these massive deficits may increase the term premium, which is a fancy way of saying that the longer term yields may be higher because it's not just the Fed that matters. So there are other things in there, but we can say, oh, we don't like what the Fed is doing. Well, who cares whether you or I don't disagree with the Fed, right? They have the bazooka, we don't. But what we can do is we can be humble in the markets, look at what the market is doing, and then take positions if we disagree with the markets and saying this is going to get better or this is going to get worse. Again, right, somebody on Twitter pointed out, oh, this is going to be a bearish point of view on the market. Well, it's not about whether you're bearish or bullish. It's a risk assessment of what could go wrong there, what are the drivers out there, and if so, are you prepared for that in your portfolio? And if you're in the camp that everything is amazing, well, good for you. I'm just saying, hey, you might want to do a reality check if that's indeed your point of view.
Okay, I am going to ask you your market outlook in a bit, but I do that in every one of these discussions. So let's save that for a bit so I can get to some folks' individual questions here. I think we touched on it a bit, but real quick, if you could just give your personal or your firm's opinion on the lag effect / the Fed being in danger of waiting too long to cut and the economy actually not experiencing a soft landing next year, but something harder. What's your general sense on that? What are you expecting?
It's my baseline. I don't see how it's not possible. And and I don't think that's a radical point of view. It's you have an economy that's slowing down.
Sorry to interrupt. I just want to contrast that. Powell took pains to say that recession was not in his baseline forecast now, that it used to be, but it is not now. So this is just one big, I just want to point out the differential between you and Powell.
Because he also said that they are laser focused on not being, he didn't say too high for too long, but that they are aware of the risk, that is a risk, and they will avoid it. If I find it, I took a note of the quote. I may have tweeted it earlier, but I don't have it right in front of me. But he literally said that they're going to stay away from that. And tell me how. It is so difficult to know all the details in the economy, how that's going to play out. You do have a sledgehammer to work with that's going to have a lagged impact, and then so with the Fed you can destroy a lot of things. You can't just put the pause button on that. It takes months for that to go through the economy, and so it's a lot of that is, again, it's on the one hand, I mean, Powell just politically can't just say, yeah, I'm gonna throw this economy to a recession, right? So there is a positive bias in his communication, but at the same time, you also need to be humble, even at the Fed chair, to say that this could go very, very differently.
Well, that's why that trust me thing really bothers me. Now he does say, hey, we're not declaring victory, and the economy surprised us before.
Just keep in mind, right? Even though he seems okay with the market pricing some rate cuts, especially if everybody in the dot plots has now indicated there will be cuts, but still, if he were to say there's going to be a more severe recession, the market would be pricing in more rate cuts, which would be more easing, and that's not in interest. So it's, again, right, it's the tea leaf reading. It's about what does he want to achieve with the communication rather what he actually means.
Yeah. Hey, let me ask you this too. 'Cause I asked this question earlier today of the New Harbor guys. We sort of, the Fed is a big bazooka, like you said, but we many people ascribe like an all powerful nature to them, right? But everything isn't in the Fed's control, right? So financial conditions have dramatically eased over the past several months, right? So as the Fed is trying basically to tighten everything and kind of tame animal spirits and whatnot, easing of financial conditions flies in the face of that, right? And then you have the fiscal spending that's been going on, right? While the Fed has been very tight on the monetary side, the fiscal side has been very loose. So how much of what we can really place in the Fed's confidence, even if the Fed is genuinely confident of what it can do, where you have these other factors that are in play?
Well, a quote, and we talked about Bill Poole briefly earlier. He, in I think it was 2009 or so, he said that the Fed is really just zipping with a straw from the ocean. And if the market doesn't like what the Fed is doing, the market is more powerful. Ultimately, even as mighty as treasuries are, they compete with bonds in Germany or the bonds in Japan. And as a reminder, the Japanese still have the yield curve control, making sure those yields don't go higher. If they were to abandon that, that is likely to have ripple effects on bonds in the US. And yes, budgets matter. There's very little correlation, if any, between budget deficits and most market instruments. But people do take notice when deficits are unsustainable and they're getting to a stage where they are super unsustainable and super deep. By the way, it's one reason, of course, why the recession has been delayed, is because normally you have the economic stimulus after the recession. The shovel-ready projects finally get off the ground when the recovery is on the way, whereas this time we have a massive stimulus that's been underway. Yes, there's a bunch of things that the Fed can't control. It's one of the reasons why the Fed probably has had to be quote unquote higher for longer. But that doesn't mean that they can turn a switch and suddenly open the floodgates again, especially if they don't want to go down to zero.
Okay, yeah. So you're confirming this, that just even if the Fed is truly super confident, they don't control the world the way that they sometimes are perceived to do.
No, but they have a sledgehammer. They do have a sledgehammer,
Yeah,
right?
no, we have to
And
really
it does help. Like when there's a banking crisis, like we had in the spring. Yeah, they can have a magic wand and saying, okay, you guys are insolvent, but not really, because we come up with this bag of tricks and you guys can stick around, right? And so they can provide emergency liquidity and drag out problems to be solved another day or not to be solved at all, which has implications. But they can ease financial conditions when markets seize up. So they are quite powerful because they have an unlimited checkbook there.
Right. Okay. You mentioned the word political earlier. We got a question here from Rajiv. His question is: Would the Fed's actions be different if there wasn't an upcoming election in November? Somebody actually specifically asked Powell about that, and he gave the typical, Fed chair, "Hey, we're totally politically independent. We don't look at that. We just do whatever the economy needs when it needs it. We're, for all intents and purposes, we don't even know there's a presidential election coming up." I don't know if the Fed is. I'd love to get your thoughts on the Fed's independence from the administration, not just this one, but administrations in general. But is there any presidential year stuff influencing what we heard today?
Well, anybody from the Fed will always tell you no. There is probably a reluctance to move rates just before an election. It has happened. I think the more relevant part comes up in May 2026 when Powell's term ends. And so any president who is in place then is likely going to replace Powell with fresh blood, especially if it's going to be a Democrat. But I don't think that it makes that much of a difference. Now, that said, the other way around, I think it does have an impact, right? The Fed policy has been slowing down the economy. I have argued for a long time that the worst of the economy, maybe just as we get into election season, that seems to be playing out right now. And historically speaking, that's not good news for the incumbent when the economy is bad. Now, there's of course the other side to it, that if you ask Democrats, they think the economy is great. If you ask Republicans, the economy is shitty, and so that's not going to change many minds. But if people actually start losing jobs, then that might tilt the balance.
Let me ask your response to the question that Powell was asked near the end, because someone did say to him, "Hey, look, if you ask economists, they say the economy is pretty resilient, it's doing pretty well. But if you ask actual households, they're really hanging on, right?" And Powell, that's what he kind of went back to. Oh, it's our job to get price stability under control. But disinflation is not prices coming down. I think people are generally stuck with these higher prices here. And if Powell is actually, if his actions are still continuing to moderate the strength of the job market, he said, yeah, it's been good because people's wages are going up, and that's going to help them out a bit. I felt like that was a little colorblind to a lot of people's real experiences, but
yeah. Well, I think we can make it much less abstract, right? College loan repayments have started again, and they may not matter to you or me, but they do matter to the bottom 20% of the income spectrum, because that's a huge chunk of their disposable income. Now, they've had a little bit of relief. Gas prices have been coming down a little bit of late from the peak, but that's having to resume those monthly checks is taking away from discretionary money. I'm not arguing here that this is good or bad. They probably should have been paying all along, but that's one of the reasons why this economy is slowing down. In addition to, of course, that credit card debt is increasing, the interest on the debt has been increasing and whatnot. So all those headwinds have a very, very real impact.
Yeah, and those aren't reasons to cheer, right? Those aren't reasons to say, oh, good, the economy's coming down from the hot print of Q3. Those are like, hey, those are big issues. If they
the Fed can't change that trajectory simply because they start easing.
That's a great point. That is actually a really great point. All right, I'm getting lots of questions here, so I'm going to keep going as fast as I can here. Let me raise this question here from Greg. This is really like a rubber meets the road kind of questions. What should mom and pop investors take from what just happened today? Is this an inflection point? Is this now game on for the markets, right? Is this a reason to go long for at least some period of time here, because everybody thinks that, Powell just removed a lot of uncertainty?
Well, I mean, to me, it's an admission that the recession is coming, because otherwise, why would he pivot? So I'm taking the other side of that.
Wait, real quick, because I want you to answer this in your answer.
Yes.
So do you think like, really, that Powell is making this decision because he's worried about something and is just not letting on that he's worried?
Well, he phrases it positively, saying inflationary pressures are abating. But the other thing, a part of the statement, is the economy is slowing down. And of course, if you have both of these things, you have more flexibility going down. The market is jumping to a conclusion that's going to be easing, and let's go and rally ahead. Now, to give a little bit more broader answer to this question, obviously, I am not allowed to give specific investment advice. What I try to tell people is, think about investing in terms of risks you can afford to take. Can you afford to be in the market and lose money? Right? You invest in the market, of course, with the intention of making money, but if you invest in quote unquote risk assets, there is a risk that you could lose it. Right? If you put your money in cash, you're getting a decent yield, and the saying is, oh, you're going to miss out on the rally. Well, is that really your goal in life, that you're not going to miss out on a rally? Or are you okay making 4 or 5% in cash? Right? So if you are a young person, have a decent job, have some money aside, you can afford to lose money in the stock market, right? But if you're a retiree and think you're gonna still have a few years left in your life, and you're worried about running out of cash, I think the calculus is very, very different, right? And part of it is, of course, you always want to be positioned beforehand as to what might happen. We briefly touched on gold earlier, right? The gold miners ETFs went up over 6% today, right? You want to do this beforehand, not afterwards. And similarly, of course, if we do have a more severe recession, you want to be prepared for that beforehand. Now, does that mean that equities can't do well? Well, of course they can be. Now, by the way, if we do have a more severe recession, value tends to outperform growth. As a reminder, we have a few darling stocks that have done great. Value has been a quote unquote widowmaker, utterly underperforming. So can you afford that risk? At the same time, during recessions, historically, it's done better. Now, we haven't had that recession. And by the way, recessions are notoriously difficult to predict. This is probably the best forecast or most forecast recession ever, and hasn't happened. I don't have a crystal ball, but what I can do is I can help people to be kind of to stress test their portfolio and think about, well, have I taken these scenarios into account, and am I comfortable with those?
All right. Great answer. And there's so many of these I want to dig into with you, Axel, but I just have to let them go by because I want to get to a nice selection of questions here. And there are some great questions. And by the way, folks, if you are enjoying this new format of having these live Q&As in reaction to topical events for the premium Substack subscribers, please let me know in the chat here. If you like them, we'll do more of them going forward. All right. Carol asks, for you, Axel, what forward-looking leading indicators do you rely on most in formulating your market outlook and your allocations for your funds?
Well, I'm a news junkie, so I digest everything and everything, and I'm trying to get as many perspectives as possible. We, as a shop, we manage over $1 billion on the precious metal side, and so one of the key things I'm looking at is real interest rates, net of inflation, longer-term indicators, as perceptions change on how tough the Fed is going to be going forward. But I look at the full gamut of things, of various stress indicators and whatnot. I actually look much less than most people do at how the S&P is doing. I care much more about what the bond market is doing, because I think that drives the world much more. And I have long decided that I want to be diversified beyond stocks and bonds. And I mentioned precious metals here several times, but also beyond precious metals. Those who have watched interviews with Adam and me in his previous life and otherwise know that I invest in all kinds of other stuff as well. But it's what I'm trying to gauge is a financial stability that something could quote unquote blow up. And then I'm watching how are the fundamentals working, and then during the many years, of course, where fundamentals were thrown out of the window because we were at zero interest rates, we learned to adjust, and so different environments require slightly different things. I actually happen to think that diversification in some ways works better now than it did a year ago, and so there are nuances I think that what should pay attention to as well.
Okay. You mentioned bonds, so I'm going to pull this up here. And again, Axel does not give personal financial advice on these videos. This one somewhat related to somebody's specific mother here. But what implications, if any, do you feel what we just heard today have for the bond market? Obviously, the bond yields started plummeting right after the Fed came out today. Is that something that you consider to going to build up momentum from here, or what?
Yeah, well, I mean, first of all, don't need to tell all your viewers, but some of them difference between a bond and a bond fund is a bond, if you hold it to maturity, it will pay off the principal, whereas a bond fund will continuously reinvest and have interest rate risk. And so if you believe that longer term rates could go higher, then there's a bigger risk of losing things. It's a risk and reward question. Again, right, if you're on the short end of the yield curve, you can fairly securely get a reasonably high interest rate, and if you go further out the yield curve, the more you're betting on something to happen. The only other thing I might want to mention, right, there have been many fortunes lost in betting on the 10-year yield because the dynamics are rather complex. It's not as simple as saying, oh yeah, the rate is the Fed is going to cut and the rates are going to come down. There are lots and lots of different things that can potentially influence the 10-year rates, and so it depends on your risk appetite, on how do you want to play this. Again, though, if you can secure a cash stream at a decent on the cash side of things, I mean, that's one of the reasons why some insurance products are selling again, because they can be packaged in a way that investors can have a steady income stream. Just as a caution, a typical insurance product, when it's sold, and the commission to the folks who sell it to you is about 10% of the value. So that's just a little reminder that somebody is making money along the way, and there might be more efficient way of achieving the same goal. But people do like to pay for peace of mind.
All right. So on that, I just interviewed Alf Peccatiello the other day on this channel, and he, and again, this was before today's Fed announcement. He was pretty confident, or pretty optimistic that bond yields are going to come down pretty substantially over the course of 2024. And one of his reasons for that is he believed that the Fed was done hiking and that the trajectory was more likely on the downside in terms of what the Fed was going to do with rates, and that the big whales who have not been buying as much on a relative basis as they have in previous decades, like the big pensions, insurance companies, stuff like that. His forecast was, okay, those guys are going to come in and start buying bonds by the handful right now because they want to lock in these rates, right? Do you share a similar outlook?
I guess yes.
Let me just tack one more into this, which is, have we seen the peak in yields?
Well, it's yes, except everything is what are the risks, and the risks is the elephant in the room is Japan. If they give up the yield curve control, there is significant upside on bond yields, right? Because the pressure that the Japanese put on does have ripple effects to the US as well. So yes, if things were rational, I would agree. I've just been long enough in the markets to be humble and saying, yeah, that should happen. Will I put my money into it? I'd be reluctant, right? And so you always want to also be a little cautious of people, whether they put money behind what they say. And by all means, Alf is fantastic in his analysis. I'm not allowed to endorse anyone specific, but the analysis is super thought-provoking and interesting. But in general, when you listen to people, right, where do they actually put their own money is at least as important as what their opinion is. Because I can say, yes, I agree with you that bond yields should be going lower. The economy is slowing down. The pension funds should invest. Am I convinced enough to bet my house on it? No.
Well, that's why I love talking with guys like you, Axel, because you don't have the luxury of just having an opinion. And nothing against Alf, but he doesn't manage a bond fund anymore. He has his own portfolios, model portfolios, but he's not managing.
I'm going to get in trouble with him. I love the work he does. So to just make that absolutely, I love that absolutely clear.
Yeah, and this is no way of criticism, but I'm just saying for guys like you who actually have client capital that you have to deploy, you can't just have an opinion. You have to have a conviction. Right?
And by the way, to just expand on that, the reason why it is not just interesting, but hugely important to study work such as ours is to get qualified opinions on issues, right? You can get the pundit say anything, and you're going to be zigzagging. But somebody like Alf, he has a framework, right? What the Fed doesn't have, Alf has. He has a framework. He has a framework in which he sees the world. You can listen to it, you can assess it, and then agree or disagree, right? It's the thought-provoking thing. If you the reason I love reading books is because there's just one good idea in there, it's worth reading, and Alf gives you many of these ideas. Does it mean I'll put my money what he thinks going to happen tomorrow? No, I have my own process, but that's listening to people like Alf is part of that.
Okay, great. And I got to keep down with this again. I could talk with you about each one of these topics for half hour at least each. Here's one from NYU grad who has been a great friend of the new Thoughtful Money. This is a bit of a rant that you and I have been on in the past, but I'll just ask it here anyways, which is, we spend all our time trying to speculate what a couple of people around a table are going to do, right? Is that ever going to end, or should we just resign ourselves to the rest of our lives? We're going to be dealing with this.
Well, no, we can advocate for the Fed to be replaced with something else, and then we can start arguing about something else. But until then, and by the way, the dot plots we had kind of thrown out for years, and then suddenly about 2 years ago, they started to be convenient for Mr. Powell, and now they're being trumped up as being something valuable. Of course, there's only one dot that matters. It's the one of Mr. Powell, right? And so it's the rest allows Powell to spin a storyline around it and micromanage where he wants to see bonds, right? So why are we doing it? Again, the reason we do it is because they own the bazooka, right? And so you want to make sure what the bazooka is aimed at. That's the reason.
Okay, but let's take his comment here about fake inflation data, where we can argue, how dependable the data they're looking at is, but they definitely tend to look at backwards data. Some of the data we can make arguments, jobs, inflation might not really map what's on the ground. Is this what's the potential that the guy with the bazooka has a really faulty sight on it?
Well, yeah, it's a problem if you shoot off the hip and you don't know what you're aiming at. But just let me briefly comment on the quote unquote fake data point of view. It is published what these data are, and so they are what they are, and we can do with them what we want to. And so that's why I also say nobody knows what 10-year inflation is going to be. What matters is how those expectations are moving relative to what you're going to get when you buy tips to inflation protected securities. Then you're buying real yield, not that you're buying the actual real yield, you're buying that as defined by the CPI, right? And then you can do your thing. What is that worth to you? And there's a big industry that stuffs money around, and you can yes, my personal inflation is different from my neighbors and whatnot, but it is relevant in allocating assets again, because what the Fed is doing impacts asset allocation, impacts asset values. And so we can complain all we want that the process is not what we would like it to be, but it matters. It matters to our savings. Now we can try to be out of sight of the savings, the financial system, but good luck with that, right? Because you have to pay for things with US dollars and whatnot. So everything is relative. But you can, if you don't like the data, you take it into account in your model. It gets more complicated, but you can still have an investment process.
Yes, you can still have an investment process, and that's where the opportunity is in the story here, is on the individual and their agency. But we still have this, guy trumping around with a big bazooka who, maybe he's got really bad nearsightedness. All right, we got a lot of questions here about the precious metals. So maybe at a high level here, Axel, what is your outlook for the precious metals right now, and how, if at all, did today's developments affect it?
So first, for full disclosure, if anybody Googles my name, I have been an insider buyer at a fund that we manage, and I'm not trying to tout that, but that kind of gives away that there are certain aspects of it that I seem to be liking, and it's not been small amounts, and so that's just as a reference point. That's in that space. Just very briefly though. Gold and miners, and they are the producers and the explorers, all have very different dynamics. Everything has quote unquote taken off today. Gold has the most imminent impact because it reacts the fastest when there's a change in monetary policy. This brick that doesn't pay any dividend is or yield is worth it if you don't get compensated for holding cash. And so when the Fed signals that the lower rates, and notably real interest rates, are coming down, then that brick is worth more priced in that currency. Gold mining side, the gold mining is set to be a levered play on the price of gold, but it's a little bit more complicated than that. The more you go down on the size of the miners, the more their credit plays, because these smaller junior companies are in perpetual need of funding, and the higher for longer environment has made it very difficult for these junior mining companies to get funding unless they're the best of them. The quote unquote good news is that they've all but been washed out, I believe. And now if the Fed really is moving to a new environment where the risks are more balanced, that means we have the economic slowdown, we don't have the higher for long anymore, and funding might become available for the more junior players. And so that could be a very fascinating time to enter. That said, just as a caution, that space is notoriously volatile, and so it is only for those who can afford the risk. And for what it's worth, recent months, actually, the junior mining segment has been less volatile. And the reason is that these stocks have been beaten down so much that they haven't had much space to move further. And so some would argue, and I would as well, that the downside risk is more limited, but don't kid yourself. These are very, very volatile stocks. And so you got to be able to bear that risk. But historically, it's one of the better diversification plays if you're concerned that equities may be going down, because the gold miners, even though they're credit plays, money tends to be allocated to them early in that process, and then provide some balance to an equity portfolio that might be vulnerable.
Okay, I'm just down through a bunch of precious metals questions here because we're beginning to get short on time. Gary here asks, what do you see happening with the gold-silver ratio? Will it get back to more sort of historical norms from where it is right now?
It's a good question. I mean, silver has more industrial use, right? And so the moment there's always a reason why silver should outperform, because it's more volatile and whatnot, and in practice it rarely ever does. And then it has these spurts of very very high volatility where it can do substantial things. Now, at the same time, if we do have a global recession, and mind you, we haven't talked much about the rest of the world, that there is a potential global economic recession at our horizon, then industrial metals maybe less in use, and silver, even though it's a precious metal, does have industrial use, and so then it might disappoint. I'm not saying it will not. I'm a bit of a simpleton in that, and then tend to focus on gold, but it's just always a caution that that there's always some way that investors can be frustrated in any investment, and for silver it tends to be a perpetual thing that people get frustrated.
Okay, another question here from NYU grad. I'm going to jump to kind of his end here, which is, has crypto stolen the safety trade? Or maybe more broadly, has crypto stolen gold's thunder, which it might have benefited more from?
So, yeah, so first of all, the way it's phrased, no, because there's no safety trade in crypto. It's notoriously volatile. But to just answer the broader question, when I look at the gold investor, there are kind of three big buckets. There's the one who is concerned about the purchasing power of the dollar, that variations of that. There's the one that invests in gold because of the diversification potential. And then the third one is the speculator. They just love a good trend and they jump on it. And so it's that third one that had moved to the meme stocks, is playing the digital assets. I have little doubt that should gold have a sustained rally, they'll like gold as much as anything else, right? But it's there, I think, that's been the most competition. In the diversification camp, by the way, our central banks as well, they have been some of the biggest buyer of gold this year.
Okay, gosh, let's see here. I'll squeeze one more in. Okay, this is from Millennial Majority. What are your views that the bond vigilantes may come back into the picture here at some point? I won't limit it to 2024, but if we sort of start going in the direction that you think things could go, could we be in a new secular cycle of higher yields?
Well, we are already in some ways, right? I mean, people, I mentioned the fancy word term premium, that in addition to where rates are going to be, that the yields may need to be higher, in part because of the deficits. On the broader question, I think that's being asked here, keep in mind that policymakers have a tremendous ability to kick the can down the road. And so whenever we think that the day of reckoning comes tomorrow, they come up with yet another idea, right? We saw it in the Eurozone debt crisis. We saw it in Greece. We saw it in many places. And there's always a tomorrow, right? Society adjusts. It might become more populist. It might become more polarized. It might become, sorry, I'm not trying to describe the current environment here. Now, that there are side effects from all these policies, but we always live another day, and we always think something is going to happen tomorrow, whereas we're really a frog in a boiling pot, and something is happening all along. And in the meantime, rather than addressing the fundamental issues, we always postponing the issues. Now, of course, there are issues like solving Medicare that cannot be extended forever, but they are tough political decisions, and they will be taken at the last possible moment, right? And it may need to be the market that imposes reform then on the policymakers.
All right, but what I hear you saying is be careful if you're investing on a thesis that says the vigilantes have to arrive by time X, because policymakers and the folks in the power players in the system can kick the can.
Not just the vigilantes. There are lots of people that say, watch this particular deadline because the world is going to end and you got to do this. There's a day after. There's always a day after. And what are you going to do then, right? The same thing is, right, I like gold. I've been investing in gold and gold miners. And I don't think we go back to gold standard, and there's no global reset. We're further and further moving away from that, right? And so, if you want a gold standard, then have your personal one, but don't trust that the policymakers will take care of it for you. It's just an illusion, because you need to have, in order to have a gold standard, you need to have fiscal discipline. We don't have fiscal discipline, right? And so it's a trying to get an understanding of the dynamics as they unfold long term is impossible to do in detail. But what you can do is you can think about, well, what can go wrong in my scenario, and can I afford to be wrong in my life preparation more broadly, and then portfolio allocation more specifically.
All right, and what's nice is you're echoing, sentiments that the financial advisors that regularly appear on this channel that they expound as well.
I can disagree with them. I'm sure they're completely wrong.
Yeah, no. It's nice when smart people agree.
The main thing though is, and even if then listen to others who have a different point of view, right? To me, it's important. Do people have a framework, and can you kick the tires on that framework, right?
Mm-hmm.
And if so, all right, am I taking that scenario into account, even if I don't agree to it? Is this something I should be thinking about?
Okay, great. All right. Well, look, I'm going to start wrapping things up here. We're going to end with your part with an extremely important question, which is, Axel, for folks that have really enjoyed this conversation, listening to you, and would like to follow you and your work from here, where should they go?
Well, you can follow me on my on Twitter. The Twitter handle is, I don't know where I find it here on the screen.
I just put it on the screen.
Here
there
we
you
go. At Axel Merk is that merkinvestments.com is our website. I can't be talking about the products we have on this program, but you can get from our website. You can find what we do. We have a newsletter there. What's nice about Twitter, that's the reason I mention it, is that I can really comment live on things that are happening. I can't discuss products there, but I can give my views on what's happening there, and provide some food for thought. Sign up for our newsletter at merkinvestments.com as well.
Great. And speaking of products, I believe you can talk about this. You were still relatively recently launched a product, right? A stagflation fund. Do you want to talk about that at all? I've got the URL for it right here. So.
Actually, unfortunately, we are liquidating that product at the end of December, because as much as we love that product, we do need to pay the bills. And to just give people a sense of the economics of that sort of product, we had revenue of a little over $300 a month and expenses of about $20,000 a month. And I am more than happy to subsidize a new product, but if people don't show their love by actually buying these products, then at some point you got to make a decision. Well, how much more do you want to support the industry and the service providers that come with it? And so that's just some context here and if you look at the long period, right, one of the biggest things that the dry spell had done with the zero interest rate environments that pushed equity prices up and up and up, it forced many people out of the industry, right? We are in the fortunate position that we have the resources to have products, develop new products, and so forth. Unfortunately, once in a while, you gotta trim the portfolio and take things back when the market doesn't love what you think that should be a great sale.
Sure. Well, that's so interesting. Yeah. I mean, look, that's business, right? As you're always trying new things. Not every new venture makes it, but what you were doing there is you were putting forth a way for people to bet on stagflation. Sounds like the market didn't necessarily have enough demand there, but I'm curious, what's your outlook? Are you still looking at stagflation?
Yes. So just on to this and by the way, I continue to believe what we do in that product. The product was really one that would benefit if inflation expectations were to rise over time, and invested in things that in the 70s paid off in a very straightforward way. There were some little things that added to it. Now, obviously, an environment where the Fed was getting tighter and tighter and tighter, that was a headwind, right? I do think what we said in communicating the product, that the reason why you get into stagflation is you have a supply shock with a policy mistake, and that's why these things last many years. I continue to believe that, But at the same time, right, if people don't buy a product that supports that notion, then they say, okay, we provided an avenue that people can participate in it, and now they got to find their own ways of doing it, and that's just as you point out, right, that's just a business decision.
All right. Well, look, I'm going to wrap things up here. First off, Axel, thank you so much for agreeing to do this on such short notice and giving us such a great Q&A here. From the comments in the chat here, it seems like folks have really liked it. Definitely want us to do it again. So folks, I hear that loud and clear. We will do more of these in the future. Please do me a favor, if you can, let Axel know your love there in the live chat below. If you want to see us do more of this stuff, please do two things. One, hit the like button, and then obviously click the red subscribe button below and that little bell icon if you haven't done so yet. But as I mentioned, the folks that are getting to participate in this live event right now are the premium subscribers on my new Substack. Definitely please go subscribe for free to the Substack. I provide all sorts of information out there during the week. But if you think you'd like to participate in some of the premium benefits like this, you also get all my Adams notes, summaries of all the interviews I do. Consider upgrading to premium, and I'm going to tell you why you want to do that in addition just to the general benefits you get. And it's not that much, folks. It's currently only about $8 a month. But sort of like Axel was talking about from a business standpoint, I just launched this Substack about a month ago. The initial default $8 price I went with, that is going to be going up. It's going to be going up to $15 a month just to cover expenses and everything. That's going to happen by the end of the year. Now, if you're already a premium subscriber, like the folks that are watching this live, don't worry. You're going to be grandfathered in at the current price that you subscribe for as long as you remain subscribed. So if you remain subscribed for the next 10 years, don't worry, your price isn't going to change. But for people that haven't subscribed yet and are thinking about it and would like to get the benefits of the notes or the increasing number of events we're doing like this, well, you might really want to think about subscribing now and not waiting until January 1st so that you can get the low price and be grandfathered in at that going forward. Just food for thought. All right. Well, in wrapping up here, Axel, I just want to give you the last word for folks that are, trying to make sense of what the Fed is telling us, trying to get a handle on where things are going, obviously trying to navigate it and not get crushed by what happens, and hopefully maybe even profit from it. Any bit of parting bit of advice for those folks?
Well, only echoing what you just said, right? Anybody you have on as a guest, yourself, right? We all run a business on the side, and yours is so that you don't have to put all your eggs into one product. You provide the service where you're talking to people, and the way you support Adam is by signing up for his premium service. Right?
You're kind.
And sorry.
Yeah,
I had to say that, right? I had to say it. But in any case, no, I mean, have a wonderful holiday, and I hope I embarrassed you a little bit by throwing in a pitch for you as the last.
Yeah, no, I appreciate that. You're being a good guest. But no, folks, only subscribe if the value's there for you. Yeah. By the way, I forgot to mention the Substack URL. It's adamtaggart.substack.com. That's right there on the screen. But no, Axel, thank you so much. I mean, I would say of all the questions that I get, one of the most common ones is just, with a world that is so pushed around, dictated to by such a small number of central planners, there's oftentimes just a lot of despair of, hey, what chance do we as the individual investors have? But there's more agency in this story than I think a lot of people think, right?
So thanks that we have another 2 hours to discuss that question.
Yeah, I know.
To just give a quick word, right? Anything that you decide to do it so that you control your destiny, right? And on the financial side, of course, that is to live within your means. Then you have more flexibility. But it's any decision that you make, right? I mean, it's your life choices. Don't be the sheep that gets pushed around. Don't be the cattle. You feel much better when you're in control of your life, and that investing in your health and whatever it is, but invest in being flexible and whatnot, so that when policymakers do things that you don't agree with, then yes, you can go out on a rant, but it's not going to destroy you because they make a decision that you disagree with.
Very well said. And folks, actually, if you want to get a good sense of the framework that Axel has for building wealth, I want to recommend a book that he wrote, excellent book called Sustainable Wealth. Really is. I'm glad you plugged me because you were being kind, but this is a genuine, solid recommendation for folks. the framework that Axel has in there, I think everybody who's looking to build wealth over time will benefit from reading that book. With that said, Axel, we got to wrap it up here, but thank you so much for doing this. Everyone else, thank you so much for joining us tonight.
Take care.